Hello, traders. Doing Chapter there from Drfx, Swing Trading Mentoring. Going to be taking a look at the trade setup that was done for the pound Aussie dollar, as well as to take us look at some of the other movements that took place on other currency pairs that were as I had predicted, and also take a look at the possibility of another trade on the Aussie US dollar, which could provide a bullish movement as part of a false breakout reversal on its daily chart. Now, of course, everything is done within the context of these 8 steps. I believe that once we follow these 8 steps, we should be able to identify exactly what is taking place on the currency pairs that we're looking at. First of all, we identify whether or not the market is trending or consolidating. We look to see where the market is going to be headed in terms of a bullish or bearish direction within the context of either trending or consolidating pair. We then look to see if there are going to be any traps, such as false breakout reversals. And once we're able to identify a trading opportunity, we then determine where the best place is to place our stop loss, where we're going to be, the type of signal that we're going to be entering the market, and to take advantage of that trading opportunity, as well as where to exit our trades ahead of market reversals. So we're going to be able to identify what is taking place on the currency pairs that we're looking at, identify a trading opportunity, and maximize on that trading opportunity ahead of a market reversal. Now, the pound Aussie dollar appeared to be forming 2 types of consolidations. One, a larger consolidation set up on its daily chart, and a smaller one in the short term on both the daily chart as well as the 4-hour chart. Now, here you can see the setup where I think that this is going to be the projected form of a possible consolidation on a daily chart, where the market has already formed these 2 bullish and bearish waves, and this recent U-turn that has taken place at support could give way to the start of an uptrend that eventually leads to the formation of a consolidation setup. However, in the short term, what could be taking place is that the market could be forming this smaller consolidation setup at the support boundary here. And so what is taking place now is that the market has provided us with these 2 small bullish and bearish waves, which you will see in a while are actually stronger on the 4-hour chart. So it's definitely an indication that the market could be forming a smaller consolidation setup in this area here in the short term that could provide us with a trading opportunity. Now here you can see the 4-hour chart where the market has clearly formed these sharp bullish and bearish waves, typical of what you see when the market is going to be forming consolidation. So the expectation is that the market is going to continue this bearish movement that has started here and continue towards this area here, where it will then possibly form another support point as it rallies once more and continues to form additional bullish and bearish waves. Now, the reason why I think that this is going to U-turn at this area here and not at support is because this trend is a fairly ordinary trend where the market is expected to provide a normal speed of movement. And when the market is forming consolidation, it usually means that if the boundary that we're heading towards has not yet been formed, the assumption is that the market does not have enough momentum to take it towards this area here. So with normal movements, normal patterns that indicate a normal speed of movement, it usually means that the market does not have enough momentum to take it towards the opposing support boundary. If it was a fast setup with fast signals, then the assumption would be that we would be heading towards this area here, and this would be the trading target. But because of the tendency of the market to pull back ahead of this area here, because of how ordinary the speed is, the assumption is that we're going to be exiting our trade at this area here, ahead of the more likely scenario of a pullback at this region here. Now, in terms of the trade setup to take advantage of this expected movement, the signal to indicate the start that we should actually start trading short is actually this signal here, this signal single bearish candle, similar to what it did on the bullish leg. And so this is the green light that is giving me to indicate that we should now be starting to look for trading opportunity as the market heads towards this area here. Now, this is a signal that was given that has led to the formation of that daily candlestick signal. So since this signal is supported by a strong setup and signal on a 4-hour chart that led to that signal, it is justifying the trade. And so what we would do is enter the close of this candle here, placing a stop loss at this region here above the ABC setup, which is also above this downtrend line, which is acting as a strong stop loss area. And given the fact that this is a small ABC signal, and these usually indicate the start of fast movements, it may take a very short time for the market to actually reach this area here. So this is a full view of what is expected from this daily chart. Bearish movement expected to continue towards this area here ahead of additional bullish and bearish waves to complete the formation of the pennant. Target, and this was a setup for the trade itself. Stop loss placed at 175, just above the C of the ABC setup and above the downtrend line. Entry taking place at the close of the candle, and the target set for 1.7335, which will be just around the area where we expect the market to slow down and begin to start a rally. Now the previous trade actually started higher up, where the market had formed a double top formation and a bearish engulfing candlestick signal, which is a very strong indication of a start of a trend, a bearish trend. And so this was the original trade. We were targeting 100 pips. But, well, and this was a setup where we placed a stop loss above the downtrend line on a 1-hour chart. And this was a setup where where we placed our stop loss at this area here. Entry took place at the close of this strong bear candle, and the target was set for 100 pips as the market was expected to decline. But as you can see here, instead of the market moving and responding to this bearish candle, it actually moved sideways for a very long time. And this was sort of a surprise given the strength of this signal, given the strength of this overall setup, which was actually also a bear crown setup, with this being the left tip, this area being the center tip, and this being the right tip with this bearish engulfing candlestick signal. So after 1, 2, 3, 4, 5, 6 candles, 7, 8, 9 candles, 9 4-hour candles, we're talking about 36 hours, which is well beyond the 24 hours within which we expect the market to respond to 4-hour signals. Because of that, the expectation was that the market could move sideways for quite a while and possibly even rally. So the decision was taken to exit the trade area, the trade here, and re-enter if we saw another bearish signal. And as you can see here, this is exactly what we did. The market provided us with another signal, and so we took advantage of it to trade what is expected to be a fast movement towards this area here. Now, one of the reasons why I think this didn't work out was the fact that this size consolidation setup is what we see as an example of situations in which both the daily and the 4-hour chart could actually be the ones that lead to the start of a movement. Now, what I mean is that there are times when the 4-hour signal, once a signal given by the 4-hour chart is strong enough, as in this case, if the movement and the signals, if the movements and trends that lead to the formation of this consolidation are being controlled by the 4-hour chart, then in most cases, this signal would actually be the one to start the movement instead of moving sideways for so long. So that is why this situation looks to be a situation in which it is really the daily chart signal that is given the green light to indicate when we should actually start trading, and that the daily chart is the one actually controlling the formation of the consolidation. You will see that, of course, in a section that deals with this topic in the second part of the trading manual that focuses on consolidation and whether or not a daily chart or the 4-hour chart is controlling the setup. This is a case in which the size of the consolidation, there are times when this size consolidation is controlled by the 4-hour chart. So that was why I expected that this U-turn here, that this signal here, would have been the one to get things going without having to wait until the daily chart gave us a signal. So this is one of those middle ground setups where it can either be the 4-hour chart or the daily chart that actually leads to the start of the movement. Now, this situation here, another possibility is that we could have held out and assumed that the market was going to be heading lower and that it would be forming a consolidation. But because of the possibility that I said earlier on, that the market could also be forming a strong uptrend as part of the formation of a larger consolidation, that was why I was hesitant about holding the trade for longer than we did, because of the possibility of a rally. So waiting until the market gave us another green light to indicate the movement bearish was, I think, the better move, instead of holding out and not being sure whether or not the market was going to continue, given the possibility of a rally to form the larger consolidation setup. So, in summary, this was a situation in which the market was forming a fairly large consolidation setup. And without the daily signal, in a situation in which the daily chart is the one controlling the movement, entry based solely on the 4-hour chart is going to be risky. As I said, my judgment was that this was a consolidation setup that could also be formed by, or controlled by, the movement started by the 4-hour chart. But as it turned out, given the fact that the market was not responding to that signal and was stalling, it was clear that the daily chart is the one that is controlling the movement. And so trading based solely on the 4-hour chart is going to be risky when the daily chart is the one controlling the movement. So this second entry was based on the daily chart signal that was given, the single candlestick signal, which was most importantly supported by a strong setup on the 4-hour chart. So this is giving the market, this is giving the trade a much better opportunity, a much better chance of actually hitting our trading target. And so this was actually possible because the trend also was fairly early, had just started. And so re-entering does not seem to be that risky of an option because of how fairly recent the trend is in terms of the bearish movement. So I'm looking forward to a trading gain from this trading setup. And this was the reason why the first trade didn't work out and why I decided to exit it and why I decided to re-enter once we saw the green light given by the daily chart. Stop loss was placed above the downtrend line on the 4-hour chart to protect the trade. And as I said before, the speed of the trend is a normal speed. So the expectation is that the market will not have enough momentum to take it towards a support target. It may actually hit the support point, but in most cases, it tends to pull back because it doesn't normally have enough momentum. So the assumption that I always do is to assume that the market is going to pull back before it actually hits that support. And that area would be the trading target to capture a trading gain. So that was the reason behind that trade setup. Moving on to the euro pound, which is also possibly forming a consolidation setup. This time we see here on the 4-hour chart where the market has given us a strong bearish signal, followed by this sideways movement that has led to the formation of a double bottom formation and a break of this downtrend line. And the expectation is that the market could rally as it forms a consolidation setup. Double bottoms are what we see here, which are very common when the market is forming consolidation setups, because they tend to lead to the start of trend changes, in this case a bullish trend change, as part of the formation of consolidation. And as you can see here from the most recent view of this chart, the market has in fact responded to these double bottoms with the start of an uptrend that is expected to take us towards this area here before U-turning and continuing to provide additional bearish and bullish waves to form the consolidation. Even though this is an uptrend, the pound Aussie dollar setup appears to be the better option because of the strength of the daily candlestick signal and the strength of the 4-hour setup on that currency pair as well. But nevertheless, this is moving as predicted based on the waves that were based on this bearish wave and based on the trend change that had started with this double bottom formation. Euro Aussie dollar. This is a situation in which the market could either be forming a false breakout reversal, or it could be in the early stages of starting a consolidation breakout. Here you can see the setup where the market has formed this range setup following this sharp bullish wave, and the possibility here is that the market could actually rally. This was what I had expected a few days ago, where the market could rally and head back inside of the consolidation. But another possibility is that instead of rallying, the market could U-turn, could continue the bearish breakout that started here and continue bearish as part of the formation of a larger consolidation setup. So I think I made a mistake earlier in the start of this analysis of this pair by saying that the possibility was either a false breakout or a breakout from consolidation. Actually, what I meant to say was that it was either a situation in which it could either form a false breakout reversal or form a larger consolidation. So these are the two possibilities: a rally back inside of consolidation, or the start of our bearish movement that leads to the formation of a larger consolidation setup. So right now we're not too sure which one of these is going to be the one that is going to take place. We're seeing where the market is U-turning right now, and so the bearish scenario looks to be the one that is more likely. So what we would need is for the market to break beyond this support point here, this low point here, to confirm that we're going to be moving bearish as part of the possibility of a formation of this larger consolidation setup. Aussie US dollar false breakout reversal possibility. As you can see here from the trading manual, false breakouts are where the market will initially attempt to start a breakout at one end of the consolidation, followed by a reversal that takes us back inside of the consolidation. So here we see the pennant setup on the daily chart, where the market has broken out initially bearish and has now U-turned fairly strongly and is now just at the support boundary. So right now the possibility is that the market could head back inside of the consolidation. It could also U-turn and resume the breakout, but given the fact that this is the current scenario, we're going to be assuming that the breakout is going to be the more likely scenario is of a bullish reversal. So in the absence of a bearish U-turn here, we're going to assume that the market could continue this bullish reversal, and so what we would need is for the market to close with a strong bullish candle above support, and then look for a trading opportunity on the 4-hour chart to trade it towards the resistance boundary. Canadian Swiss franc moving within a pennant consolidation setup. This is a setup on the daily chart that has been formed over the last several weeks, and the market recently moved bearish, and the projection was that the market was going to rally at support and take us back towards resistance. And as you can see, this is exactly what has taken place, with the market just rallying just below the resistance boundary once again. But because of the weakness of these candles here, and because the only time the market finally provided us with a bull candle was at this area here, we're talking about just 25 pips in terms of a trading opportunity. So this was not really worth it in terms of the risk. But nevertheless, it showed the fact that we were able to identify the overall setup and identify the expected rally. But in this case, this is a situation in which the signal that was given was not strong enough to justify actually taking advantage of our accurate forecast. US Canadian currency pair also looks to be forming a consolidation setup. Again, this was what I had seen several days ago with this bullish and the start of this bearish wave that I thought could lead to the formation of this consolidation setup. This was a scenario on the 4-hour chart within the context of that projection, with expectation of the market forming this consolidation setup and continuing with this bearish momentum that had started above this uptrend line. But instead of doing that, the market rallied sharply, as you can see here, taking out this bearish candle. But nevertheless, what I also said was that What was possible was that the market could form a double top formation and continue the formation of this consolidation setup. And this would what it would look like on the 4-hour chart. And as you can see here, this is exactly what has taken place, with the market U-turning aggressively bearish and forming this double top on the daily chart. However, again, this is a situation in which we were not able to take advantage of this accurate forecast because of, as you can see here, this aggressive and very large 4-hour chart, 4-hour candle that would have required too large of a stop loss to take advantage of it. But nevertheless, it showed an example of an accurate forecast in terms of what was possible on the US Canadian dollar, which worked out as predicted, but unfortunately it did not provide us with the trade setup to actually take advantage of this expected decline. So in summary, the first trade on the pound Aussie dollar stalled because it was a situation in which the market actually required the daily chart to provide us with a signal, and not just the 4-hour chart signal. So the decision was made to exit the trade early and re-enter only after the market had provided us with another green light to confirm the start of the downtrend. And this green light was given in the form of the daily chart signal, which indicated that the market was going to be responding to the daily chart signal. And given the fact that this was given and was supported by a strong setup on the 4-hour chart, which is very important when we're trading based on the daily chart signal, that it is supported by a strong signal and setup on the 4-hour chart. This is now giving us a much greater chance of a successful trade, and that it will hit our trading target within a very short period of time. So most movements in the market, in the Forex, can be accurately forecast, especially when we're using candlestick formations with my approach to analyzing the market. But there will be times in which the market will move as projected, but will not provide us with a trading opportunity to take advantage of this accurate forecast. So going to be waiting until the pound Aussie dollar hits our trading target, and then going to be looking forward to another trading opportunity, either on that same currency pair, or maybe on the Aussie US dollar, or on another currency pair that could provide us with a trading opportunity. So going to be looking forward to some more trading gains within the next couple of days as we take advantage of the strong candlestick signals provided by the daily chart and the 4-hour chart within the context of my aggressive swing trading methodology.